Hi, I'm Juliet Schooling-Latter from Chelsea Financial Services, and today I'm talking to Richard Colwell, manager of the elite-rated Threadneedle UK Equity Income Fund. Richard, thank you for joining me.
No, thank you.
The UK stock market lagged other areas last year. It just didn't recover like other markets did. But is it still cheap, or is it just that other markets like the US are looking a bit expensive again?
No, I mean, I think it's suffered sustained periods of outflows as an asset class that predates the pandemic crisis and even predates the Brexit referendum in 16, really. It almost goes back to when we stopped doing the post-financial crisis money printing by the central bank sort of 6 years or so ago. So we've seen sustained outflows from the asset class, and therefore there is this real valuation opportunity that's opened up. And the crisis last year just amplified that. So although there's a lot of post-match analysis to try and rationalise why the UK didn't recover as sharply as other markets last year. I think a lot of it is to do with sentiment, and I think it does predate the pandemic.
Right. And I'd hope that the positive vaccine news and the Brexit deal might have given the UK stock market a little bit of a boost going into the new year, but now we're on lockdown again. Was I hoping for too much too soon?
No, not at all. I mean, I do think Main Street and Wall Street are not the same thing. So don't do a kind of weather forecast on how our politicians or how indeed our economy are doing in the pandemic crisis. And it is very incredibly early days, but I do think it is noteworthy that at the back end of last year, once we did have the vaccine news, that the UK equity market did respond more positively. And at the very start of this year, now that we've finally got our late, thin Brexit deal, you are starting to see international investors who shunned the UK equity market over the last 5 years revisit because of that valuation arbitrage that I was talking about. So if you're a dollar investor, I think the UK equity market is now credible and an attractive area to revisit. And that marginal buyer, rather than sustained marginal seller, will make a big difference. And I think it's not just a trade with respect to reflation and the money supply growth, which has very quickly become a bit of a global consensus trade. I think it's a broader based value opportunity across the UK market, and it's not just about commodities and financials.
And what about dividends? Will they recover this year? What kind of yield can income investors expect this year and perhaps in 2022?
Yeah, I mean, the yield on the UK market, despite the magnitude of cuts that we endured last year, is still attractive in a zero interest rate world. You know, that the UK market is yielding about 3%. So personally, I'm obviously biased, but I'd take that on all day long versus a not dissimilar yield on high yield bonds. And yes, we will start to recover this year. It's going to be baby steps, but I do think there's potential for double-digit growth in dividends from this much lower base across the UK market. So although we will take several years to get back to the quantum of dividends the UK market generated in 19, hopefully active income funds that don't replicate the index can give a very attractive risk-adjusted return, of which starting at a 3 yield, that's a useful kicker. And I think the kind of accusations of cynics pre-pandemic was that, oh yes, the UK market has a big yield, but that's all because it's got over-distributing, twilight industries, oil, etc. And I think, at least post the big cuts that we saw in 2020, we've got that monkey off our back, really. That we've had the rebasing, the dividend cover when it comes back vis-a-vis the earnings will be in a better ratio, and therefore, the quality of those dividends is better than it was in 19.
Good news for income investors then.
I think the notion that income as an investment strategy was invalidated by the quantum of cuts post the crisis was very wrong. The dividends will always be a key component of the total return proposition, and the culture within the UK equity market, I think is a really good underpinning, but it should never be one-dimensional. It is all part of a total return, and I'd ask you to remember, coming out of the financial crisis 10 years or so ago, income funds actually did very well in that period of 2010, 11, etc. Before dividends were back on the roster with some companies, you could capture that first flush of capital growth as those companies recovered post balance sheet repair work.
And you have a think active, act lazy approach normally. Has that changed at all in the current environment?
No, I mean it's a phrase that I didn't invent that phrase, I should say, but I think it certainly captures what I was trying to say, is that myself and our team, we were very active in appraising stocks that we own and potential stocks that we don't own. So there's a lot going on beneath the water, if you like. We're always, engaged with companies and trying to do scenario analysis work to try and think what could excite markets in a few years' time, rather than just sort of following the puck on a daily basis. But in terms of executing changes to the portfolio, I will be more sloth-like, if you like, rather than trying to be a kid in the sweetie shop and trying to buy everything that's going up on that day or what have you. So obviously, all things being equal, when you get big dislocation in markets like we endured last year, it should be big opportunity to reappraise what you own and what you don't own. And that certainly, as a team, is what we did. But it's no cycle is the same. But 2020 was very different in the dynamics of how that market crash, effectively, that flash crash came about. Very different from 2008 and 2000. So we were working very intensely. I think we worked well as a team, did a lot of work, very engaged in terms of fundraisings to ensure businesses that we think can come out of this stronger. But if they needed additional liquidity to be able to swim to the other shore, then that we wanted to be involved, and so we were sort of in the camp working very hard on that. So that was exciting but very important part of what we were trying to do last year.
So does this all add up to the UK stock market being the buying opportunity for the next decade, do you think?
Well, we're long-term investors. A decade is a long time. I think there'll be some twists and turns, but as I say, I do think that what we see in markets these days is opinion following share prices, and the narrative after that sustained 5 years plus of underperformance of UK equities in what frankly has been buoyant global markets fueled by huge liquidity stimulus from central banks. There's a narrative that we can do better in other asset classes, etc. But I think from here, and the fact that valuation does matter, contrary to perhaps some of the commentaries in the last year or so, given where interest rates are, valuation does matter. And I think the starting point for UK equities gives us a great opportunity to deliver good risk-adjusted returns out of UK equities from an active fund that's not mimicking the index over the next 5-10 years. Yes.
Good news. Richard, thank you for chatting to me today.
Thank you.
For more information on Threadneedle UK Equity Income, please visit chelseafs.co.uk.